As we enter the second quarter of 2024, the incoming data suggests that the global economy is more resilient than initially thought. 2024 global GDP growth has been revised up. Global inflation is easing, but not at the pace envisaged at the beginning of the year. Unemployment rate in the US inched up to 3.9% in February, but has remained below 4% for 25 straight months. The spate of stronger than expected set of data has caused the bond market to revise both the quantum and starting date of the rate cut cycle in the US from 5 cuts at the beginning of the year to 3 cuts now, and the first cut to start from June rather than March. That said, bond market remains optimistic that global economic growth achieves a soft landing in such a manner that allows central banks to start the rate cut cycle in the first half of 2024. Any further change in rate cut expectations may have potential to push bond yields higher in major economies in our view. India is in a sweet spot at present on macroeconomic landscape. Third quarter GDP expanded at 8.4% year over year, and full year GDP growth is expected 7.6% in FY24. Further, Indian economy is expected to grow at around 7% in the next year as well. A sustained 7% plus real GDP growth will have profound positive impact on government finances, infrastructure growth, and overall living of standard of our citizens. At the same time, it is important that inflation remains in check, with headline inflation trending towards 4% target level. Average inflation is around 5.4% in FY24. RBI expects average inflation to trend to 4.5% in FY25. This is great news. We are hopeful for a normal monsoon and bumper crop production this year. This should keep food prices in check. Bond market participants are pleased with the trajectory of the fiscal deficit, which is trending lower at faster pace, and trade deficit, which remains well contained and below 2% of the GDP. Overall, we are in a great place at the moment. April MPC is going to be a placeholder meeting with no significant change expected. Bond market participants have low expectations from April MPC. The MPC may take note of the evolving global growth inflation dynamic, but may not alter their GDP or inflation forecast from the Feb MPC. Bond market participants expect MPC to embark on a rate cut cycle only after the Fed rate cut cycle begins after the elections. Based on this, there are low expectations from the April MPC. Sentiment in the bond market remains positive amid news of index inclusion and improvement in India's growth inflation dynamic. Sovereign bond yields have declined by around 20 basis points from the beginning of the year, and the sovereign yield curve has experienced bull flattening as investors position for a potential decline in policy rates in the second half of 2024. Based on the RBI's average inflation forecast of 4.5% in FY25, we expect the RBI to cut repo rate from 6.5% currently to 5.75% at least this year. This should push the benchmark 10-year government bond yields towards 6.25% to 6.5% range in our view, assuming normal monsoon and no negative news on energy front. Corporate bond yields should also experience a gradual decline with tightening of credit spreads on the long end because of heavy demand of AAA rated long-term bonds. We remain bullish on sovereign bonds. We have been asking investors to increase duration in their portfolios. We continue to recommend the same. Based on our outlook on rate cuts and potential decline in sovereign bond yields, we believe that the risk-reward ratio is still in favor of sovereign bonds. Investors should expect decent accrual as well as potential price appreciation from sovereign bond maturing 10 years or longer if they remain invested for at least 1 year. The risk to our bullish outlook may come from flaring of global inflationary pressures and consequent change in the monetary policy guidance. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.